started, and I try to put the closed captions as well. Some people want to do that. No, I don't see that option. Let's go and we're going to see how it goes. Okay, chapter 1. What's the most important of chapter 1 is obviously the cycle. That's not so important with the principal agent theory, with the auditor sitting between the principal and the agent, where the principal is the owner of the company or shareholder and the agent is the manager. But the assertions for the transactions and events which are done for the period under audit. This is the mostly, probably the most important thing from this chapter. So the assertions are occurrence, completeness, authorization, accuracy, cutoff classification, and presentation. This is for the transaction and events again. And then we having the same level of assertions, but that's for the account balances at the end of the period. This is probably the most important thing from this chapter. Those assertions, I want you to know them by mind. If you have to memorize them, memorize them. Because once you go to the CPA, in the CPA world now, I don't know what's going to happen in 2027, honestly, but I want you to know those ones. Even if you don't become auditors one day, I want you to know those assertions. The next thing important in this chapter was the report, the final report. We're going to talk about the reality, audit, risk, and evidence that are gathered to the audit, but the report was important, and the type of the reports that the auditors issue at the end of the audit, and the audit type are unqualified, qualified, adverse, and disclaimer. Again, on the unqualified, the meaning of the unqualified is that in the context of qualified means that because of the financial statement, a free from material misstatement. And the auditor does not find it necessary to qualify his opinion or her opinion about the fairness of financial statements. That's what specifically means unqualified. Now, the qualified is something else. What will be that something else? That's the qualified means that the statement contains misstatement that the auditor considered material. And in this case, the management refuses to correct the misstatement. Or the other option that we have here is suppose that the auditor is unable to obtain sufficient or appropriate evidence regarding the specific account. That can trigger this qualifying report. The last one is, sorry, not the last one, the next one is adverse, which the auditor find that the statements which are under the audit contain a statement that's only that he consider or she considered to be material. And they basically affect the interpretation of the financial statements. The last one is the disclaimer. Obviously, the auditor just refuses to issue any report, just withdraw from the audit completely. That's what's important from chapter 1. Now, from chapter 2, now having those things in mind, now we can move to chapter 2 and continue with our chapter 2. Let me stop sharing this and start sharing chapter 2. Now, in chapter 2, let's hold it. Bigger. Should be there. In chapter 2, what we started was the type of the auditors that we have. First thing, the type of services the auditor provide. Can provide audit services, can be provide assurance services, can provide their own non-audit services. All those are provided to the clients. The next thing that we discuss is the audit companies that we have. The audit team, what's the members of the audit team and what's their responsibility within the audit team. What's happened during the period of the history of the audit and how the auditors from the company that providing the management services and consulting services become only the company that provide only an audit. Now this one is important in terms of the cycles that we have in the company. So as you can see here, the processes that happen in the company, in the organizational transactions that happen within the company, the first one is the revenue process. So we're going to see later that we're going to chase first from where the revenue coming from. Obviously, the revenue is going to trigger the finances, money that's coming in the company. Then we're going to see where the money go in terms of the purchases. The other place that the money go is the human resource or the payroll. And the last one is the inventory management process. So we have the auditors consider 5 processes in the company: revenue, financial, purchasing, human resource management, inventory management process. Then we're going to see those processes, and we're going to go deep in each of those so you can see what's inside. We talk about the corporate governance and how the audit committee is within the scope of the board of directors. So to some extent, the board of directors appoint that audit committee based on something, and the purpose of the audit committee is again to evaluate the 5 components of the business process, which is the start always with the revenue. Remember this, everything starts with the revenue. What generates the not income, because income is not the right term. From where is the source of the revenue for the company? That's the first thing that we chase in. Now, when that revenue convert into cash, we want to cash that process as well. After we have the cash, then we're going to see how the cash is going to be converted to something else. First, the cash is going to go to the purchases. Second, is going to go to this human resources. And the last one will be for the management, for the inventory. Which all of those are going to start eventually generating revenue again. Which is the organizations that affect the audit in Canada. We have Canada Securities Administrator. We have Chartered Professional Council of Canada. We have the Public Accountability Board. We have the Auditing and Assurance Standard Board, and we have the Auditing Standard Board. Those are the ones who set up the rules for auditors in Canada. International Accounting Standard Board and International Audit Accounting Standards. The International Audit and Assurance Standard Board is the one to set up the audit standards on the international level. Now, the audit standards, you're not going to see, unfortunately, I won't be able to show you any audit standards because, well, maybe I can print you the audit standards, some audit standards, and give it to you if you're interested, but you're going to let me know. You won't have access to those one until you become a part of the CPA world, and then you're going to have access to standards. Those help to ensure the financial statements are conducted consistent through the, obviously for the international world, and for Canada, in Canada. And also, financial statements serve as an important set of criteria to evaluating the quality of the performance. That's the standards. So basically, the auditor performance will be evaluated based on how they're applying the standards and how strictly they follow the standards. Principles which underline the audit is the purpose, responsibility, performance, and reporting. Now we're going to go to the principles, and this is directly from the standard. The purpose of the audit, the purpose of an audit and premises upon which the audit is conducted. The purpose of the audit is to enhance the degree of confidence of the intended users of the financial statements. And keep going, keep going, keep going. I'm not going to read you the standards. Again, I'll try to get you standards if you're interested. I'm going to print you the standards and I can give you the extract from the standards so you can see the responsibility is, let's see, what's the responsibility for the auditors. Now, the auditors are responsible for having appropriate competence and capabilities to perform the audit. So that's their responsibility to have the appropriate competence and capabilities. Complying with the relevant ethical requirements. Second. Third, maintaining professional skepticism and exercising professional judgment through the process of starting with the planning and performing the audit. So not only through the audit, but also from the start with the planning and through the. Now, performance, to express opinion, the auditor then receives assurance about whether the financial statements as a whole, again, we're looking at the statements of big picture, are they free from material misstatements? Whether those are due to the fraud or just to error. Again, they have to obtain this reasonable assurance, which again is a high but not absolute. How they're going to do? They start with the planning, then going to determine and apply the appropriate materiality level, identify and assess risk of the material misstatement, if there are any, and obtain sufficient appropriate audit evidence. So again, everything starts with the process planning, assessing the situation, identifying and assessing the risk, and getting evidence. Now, the auditor is unable to obtain absolute assurance the financial statements are free from the material mistake because the inherent limitations. So basically, there's a limitation which the auditors cannot do anything about it. First one will be the nature of the financial reporting, may mean nature of the business, nature of the audit process, and the need for the auditor or for audit to be conducted within the reasonable period of time. Again, in the audit, we are pressured by the time. Auditors are pressured by the time. So the chances they to miss something, it might be there. Reporting, again, we already saw the report based on the evaluation. Once they do all the process for the audit process, based on the evaluation of the audit evidence, which they obtained on the final stage of the what was that here? On the final stage, obtaining sufficient appropriate audit evidence under the performance. once they're getting those evidence, auditors will express in form of the written report opinion, modification of opinion, or denial of opinion in accordance with the auditor's finding. So based on the whatever he finds, he's going to express his opinion in form of the report, which can be opinion or modification of opinion or denial of opinion. The opinion states whether the financial statements are prepared fairly in all material respects in accordance with the applicable financial reporting framework. Now, which will be the framework depends on where the audit is conducted. If it's in Canada, it's only for the Canada purposes. Canadian standard is for international financial reporting standards. Depends on which reporting framework the entity reports. Now, once we get to this, then we're going to see the nature of the audit standards. Again, we have audit standards for Canada, and we have the international audit standards. Those are the ones who are doing this conceptual framework of the coding standard for the Canadian standards, international international audit standards. Now, in the Canadian standards, we're going to have sections. It's pretty much the same like an international financial reporting standards set up on the different sections, which first section is going to explain the general principles responsibility. Then we're going to start with the audit process, planning and risk assessment, or gathering the audit evidence, using the work of the others if we need to use the work of the others. Audit conclusion and reporting, and some special consideration, which will be the special reporting, which are not related to exactly to the. Obviously, the standards, we're going to have some codes. The international standards for audit consist 36 individual standards covering the full range of the audit topics. In the Canadian standards, obviously, will be a little bit less than that. That's what's important here. Now, on the ethics and professionalism, there's a high emphasis on the ethic. The ethic is a system of or code of conduct based on the moral duties and obligation that indicate how we should behave. Now, if you're looking for one of the definitions of the ethic, that can be which is again a system of code of conduct based on the moral duties and obligation that indicate how we should behave. Now, based on the situation, based on the which situation we are, there will be different ethical standards. Professionalism, that's a conduct, aims, or qualities that characterize a profession or professional person. That will consider professionalism. Now, the rule of the professional conduct, now it says that our professional, regardless of which they are in medicine or law or accountant, operate under some type of code of ethics and code of conduct. We all bind by those codes, which make it easy for the public to be assured that the people who's doing all those activities maintain certain qualities. The CPA rules of professional conduct also establish the acceptable behavior for the auditors. Once you become part of the CPA, first thing that they're going to throw to you rule of professional conduct and ethical standards. The CPA rules of professional conduct applies to all auditors including the auditors, public companies. So that's concluding the chapter 2. As you can see, the most important thing in chapter 2 is the knowledge about the processes inside of the company. Everything else is a little bit more just basic explanation of the audit profession, who the auditors are, what kind of rules they have to follow, which kind of standards they have to follow. An organization. So the chapter 2 is basically, again, some kind of additional knowledge that you may gather about the auditor. So let's move on from chapter 2 and let's jump to chapter 3 now. Chapter 3 is more interesting because now we're going to start dealing with actual audit. Now it's getting a little bit more interesting. Chapter 3, let me see how it's projected. Then deeper. Yes. And let's start now. In this chapter, we're going to talk about now it's getting serious. Now we start doing the audit. So what we're going to do when we start doing the audit, first we're going to do the planning. We're going to do some tests and we're going to assess the material. Everything. So now in the audit, you have two scenarios. One scenario is you accept a new client. Second scenario is you dealing with the client that you already have, and you just continue working on with the client. Those are the two basic scenarios. Once under each scenario, you're going to have to do these preliminary engagement activities. And then you're going to start planning for the audit. Now let's start with first scenario, brand new client. Before accepting a new client, the accounting firm must determine two things. First, am I capable to perform the engagement? So whatever client asks me, am I capable to perform? Second thing is, if I take it, is this comply with the legal and the relevant ethical requirements? This is even before you accepting the new client. And the third one is to consider the integrity of the client. So let's go one after another. Capability, performance, engagement. So how are we going to assess those one? First will be, do we have necessary technical skills and knowledge to relevant industry or subject matters? Do we know enough about the industry that the client comes from? Do we know about something specific that's happening in that industry? In Vancouver, Canucks ask for the audit, and up to this point, we don't do an audit of the mining companies. Do we have the technical skills and knowledge to that particular industry? Now, do we have enough personnel that have experience with the relevant regulatory and reporting requirements? So every industry has specific requirements and specific regulations. Do we have person in our team or in our company that has experience? Do we have sufficient people, personnel, with the necessary competence and capabilities? Do we have access to the specialist if we need one? Again, we may have a company that requires something very specific, do we have a specialist somewhere available, or we know that if we can bring to the audit. And the last one is, are we able to complete the engagement within the reporting deadline? Again, for those for the audit, the people are sensitive in terms of the time frame, and they want the audit reports to be done within the specific period of time. The question is, once we know the company, once we know the industry, once we assess that we have the people with the experience, when we have the sufficient personnel and we have the specialists, can we conduct the audit within the time frame? This is the first step. But this step's going to tell us, do we have the capability to perform the engagement? And we're moving to the second one. We have to determine, are we independent to the company that we about to audit? Do we have any relationship? Can we accept the company or the entity without violating any applicable regulatory agency requirement or rule of professional conduct? Is there anything that we can be held liable or responsible of breaching the requirements or professional rules of professional conduct? This is the second thing that we have to assess, and that's before we accept the client. And the third one is, now we have to consider the integrity of the client. So what that means, we have to determine the integrity of the business and business reputation of the client principals, owners, key management, and those charged with the governance of the company that we are about to audit. Then we have to consider the nature of the client's operation, including the business practices. Are they money laundering, or they actually doing the actual business? Then information concerning the attitude of the client's principals, owners, key management, and those charged with the governance towards such matters as internal control or aggressive interpretation of accounting standards. So now we have to assess those things as well. Again, that's before we accept the client audit. Then we have to see, is there any indication of an inappropriate limitation of the scope of the work? Is there any indication that the client might be involved in some activities, which are legal activities or criminal activities? And the reason of the proposed appointment of the firm and non-reappointment of the previous firm. So what that means is every company is going to approach us for the different specific activity. They may want audit, or they want some other reports related to some other specific things. The question is, what's the reason for that appointment that the company comes? So once we evaluate the client, we have to evaluate the client retention periodically. Near the audit completion or after the significant event, we have to see, is there any conflict over the accounting and audit issues? Or is there any dispute over the fees? That's when we continue with the client retention. So basically the first apply for when we have the new client, before accepting the new client, we have to assess all those activities. Now if we continue with the client that we already have done audit last year, first we have to evaluate our retention. Are we still independent? Is the client still doing any illegal activity? If he's changed his business or moved to the direction that is not appropriate for us to maintain our professional conduct and ethical standards, we may refuse. Let's continue with the client. Now on the preliminary engagement activities, now we move to the next stage. Let's say we accepting the new client or we continue with the client that we have. Now we have to do some preliminary engagement activities. First, we have to determine the audit engagement team requirements. And then we have to assess the compliance with ethical independent requirements. So how are we going to establish this understanding with the entity? First, we should establish the understanding with the entity about the terms of the engagement. Now, how can we do that? First, we can go with the engagement letter using the work of the internal audit function. And we're going to check the role of the audit committee if there's only committee under the company under the audit. The engagement letter, it will be the document, and that document will document the term of the engagement. That letter should include objectives of the engagement, management responsibilities, auditors' responsibilities, and if there's any limitations, those limitations should be on that letter of engagement. What exactly we're doing? Engagement letter, again, is formalized arrangements. It's going to look like this. I'm going to print you, try to in the company that I'm working, we have compilation. It's not audit, it's a compilation. So I can easily print you one of the letters so you can see, and you're going to see all those requisites, which are requirements for the letter. There's a certain requisites which has to be on the engagement letter, otherwise it's not going to be considered engagement letter. Now again, it's going to be, this is a sample, the company who's doing the audit, the company has the audit, the date, to whom the letter is addressed, and keep going. Now, who signed the engagement letter? That will be usually the owner or one of the, what will be that? That will be the principals of the audit company. The company is doing audit. The engagement letter, in addition to the terms mentioned in the sample engagement letter. Now, that's why it's important you to have the textbook, because on the textbook you're going to see the Exhibit 3.1, the sample of the engagement letter. And those will be the arrangements for use of specific specialists of internal audit. So if we need to require services of the specialists or internal audit or the internal auditors, we have to specify those on the engagement letter. Any limitations of liability, any additional services that's going to be provided besides the services which are required by the client, and any arrangements which are related to those additional services. Next step was to assess the internal control. one of the part of the internal control is to check is the internal audit functions. Factors that we're going to evaluate will be the objectivity, competence, and approach. Objectivity will be whether the organization status of the internal organizational status of that internal audit department, including the functions, authority, and accountability, supports the ability of the functions to be free from bias. So now what we're doing is we're chasing inside of the company. Is there anything that we can use in our audit process to make sure, again, we're chasing the financial statements free of misstatements and errors? This is our objectivity on the audit. So we're going to find out, is there internal audit? And that internal audit has to have some function, or which are the function, which is the objective. Objective of this internal audit is whether the internal audit department's free of conflict responsibilities, whether the audit committee oversee employment decisions related to internal audit department, whether any constraints or restriction placed on the internal audit department by the management or audit committee, and whether internal auditors are members of relevant professional bodies. So if you're working, let's say you're going on the audit in what company will be that? Let's say a mining company, and you see in the internal audit department, you have people with PhD in science. Obviously, that will be not appropriate for that specific audit, internal audit department. So we have to check those ones. Then we're going to check the competence. The competence is whether the internal audit department is adequately and appropriately resourced relative to the size of the entity and the nature of the operations. If we have a multi-billion, not multi-billion, let's go with a little bit small. Let's say you have a company with 1,000 employees, and you have one internal, the internal audit department is there's only 2 people in the internal audit department. That's based on the size of the people, that might be appropriate. But let's say if the revenue is in the range of let's say $500 million to $2 billion, maybe that won't be appropriate. Whether established policy of hiring, training, and assigning the internal auditors to internal audit engagement exists, whether the internal auditor has adequate technical training on proficiency in auditing. So we're checking the competence of the people who are part of this internal audit. And the last one is the systematic and discipline approach. The existence, adequacy, and use of the documented internal audit procedures or guidance covering such areas such as risk assessment, work programs, documentation, reporting, the nature of and extent of which is commensurate with the size of the circumstances of the entity, and whether the internal audit department has appropriate quality control policies and procedures or quality control requirements in standards set by the relevant professional body of the internal auditors. So basically, again, we start with the objectivity. Is those people objective? Second, are they competent? And what kind of approach they follow? Do they have systematic approach, which is supported by the documents, by procedures, by structures, which is made in the company, which support that internal audit function. Then with the audit committee, now with the audit committee is Canadian Securities Authorization National Instrument 52-110 requires the following for the audit committee members of public companies. So if the public company has the audit committee, which are the requirements? Requirements is the member of the board of directors and independent. Directly responsible for overseeing work of any registered public accounting company employed by the company, must pre-approve all audit and non-audit service provided by the auditors, must establish the procedures to follow for complaints, and must have authority to engage independent counsel if it's needed. This is the functions, and this is the requirements for the audit committee, which is in place. So basically, we as an auditor, we're gonna check, is this in place when we can? So we're gonna check is the internal audit? Is this internal audit functioning appropriately by having the objectivity, competence, systematic, disciplinary approach? And then we're gonna check this audit committee. Is the audit committee within the requirements? Once we do that, then we're gonna start applying the audit. Under the audit, we're gonna have the audit strategy and audit plan. What's the difference? The audit strategy is more general, while the audit plan is more detailed. First, we're gonna develop the strategy for conducting the audit. That will help us to determine what resources I need to perform the engagement. How are we gonna do it? Are we gonna hire additional specialist on which area? Now for the audit plan, auditor then develop the audit plan. The audit plan is the most detailed, more detailed than the audit strategy. Basically, the audit plan should consider how to conduct the engagement in an effective and efficient manner. So how can we achieve everything that we need to do? Be efficient and be on time. Be on time means save money for the client. We're going to see later that's one of the objectivity of audit, not to spend too much time. Now, when preparing the audit plan, which is the most detailed, auditors should be guided by the results of the client acceptance. So remember, before accepting the client, we're doing the check with the client, we follow some steps. Once we're having the continuous client, again, there's some procedures we have to follow these steps. And we have to be guided by the procedures performed to gain the understanding of the entity and preliminary engagement activity. Which should be those steps? First, we have to assess the business risk. Then we have to establish the materiality. Then we have to consider, is this one location or multi-location company? Then we have to assess the needs of the specialists. Means, do we have the capacity as auditor to perform the audit by ourselves, or we're gonna need the specialists? Then we're gonna consider violation of the law and the regulation if there are any. Then we have to assess and identify related parties in there. Then we have to consider additional value-added services. And we have to document the overall strategy plan and prepare the audit program. As you can see, a lot of technicality here. Again, keep in mind the main idea. New client, existing client. If it's new client, we have to do something. If it's existing client, we have to do something. Then we're moving to the next stage, assessing what we have in place. And what we have in place is that follow the object. Is it objective? Is it competent? Follow the procedure. Then we're going to the audit. On the audit, we're going to have a strategy and audit plan. Under the audit plan, we have to go to the business risk, materiality, and we have to document the audit strategy, audit plan, and prepare the audit program. How are we going to assess the business risk? By understanding the entity and the entity environment, or the business environment that the entity working in. By identifying the business risk that may result in materiality misstatement. If we're working under the situation where the specific business is affected by something that's happened in the general business environment, and people from that type of business are tend to have a covenant on their. I'm trying to figure out some example here. They have that type of businesses struggling with the sales, and they basically borrowing the money from the bank, and the bank usually asks the covenants. So if those covenants are in the process of violating the covenants, that should trigger assessing the risk in that area by understanding that, hey, in this particular business or right now in the industry, people doing these things. Then we have to evaluate how the entity responds to those business risks and ensure that the responses have been adequately implemented. So basically, every time when we check something and we see, okay, we understand the business, so that should give us a confidence. When we identify the business risk and says the business risk is not so high, then that should reflect in our audit plan later that we have to establish. And based on this information, then the auditor will assess the level of the risk of the material misstatement for the financial statement accounts. Options are either the risk is high, either the risk is low. But when we're going to do, when we assess the business risk. Then we're going to establish the materiality. We're going to have two types of materiality. We're going to start with the overall materiality. First, we're going to establish the tolerable misstatement for single account. And then we're going to establish the tolerable misstatement for disclosure. As you can see, the importance of disclosures are pretty much the same as the disclosure for single account. Accounts and disclosures are the same level important. Then we're going to again, we're going to spend more time on this a little bit later, not right now, on the establishing materiality. That's following the next steps of the planning, which the next step is consider the multi-locations. For the multi-locations is which will determine the location of the business units, which has to be audited and extended the audit procedures. Obviously, if we have more units, then we have to extend the audit procedures. Then we're going to assess the risk of the material misstatement to be consolidated to the consolidated financial statements. If we have a multiple location, obviously we're going to have to do consolidation. So we're going to have to establish the material misstatement on the consolidation as well. And we're going to correlate the amount of the audit attention devoted to the location or the business unit within the level of risk that we assess inside the entity. So if the risk is high, then we have to put more procedures and we have to pay more attention. If the risk is low, then less attention. Again, there's a correlation, correlates the amount of the audit attention with the level of risk. Then we have to assess the needs of the specialist. This is a major consideration in the planning of the audit. We may have the IT specialist, or we might have to get one. The use of the IT specialist, that's a significant aspect of the audit engagement. And having the IT specialist, that's going to prevent that will be help us if we have a presence of complex information technology. Then we have to think, is there any other specialist that we might to consider? Next one will be the let me see how is my charging the battery. Next one, we have to consider the violation of the law and regulation. Is there any illegal activities inside the entity? First, we're going to focus on direct and material, and then we're going to focus on the indirect and material. Example will be tax and pension law and regulation. If we have those one, we consider the law and regulation as part of the audit. Evaluation of the environmental protection, then we have to be aware that may have to be occurred, investigate, and brought to our attention. So they might be direct or indirect. So we have to assess both. I'm going to skip this knowledge assessment. I'm going to continue with the next one. The information of the circumstances that may indicate violation of the law or regulation. Actually, suppose that the client was violated, was involved in the oil and gas industry. What law or regulation might be applicable? Now, let me see if that will be responsible, a related answer to this type of question. That might be relevant for all of those will be relevant for this oil and gas industry. As you can see, every industry has special regulation and special requirements. The question is, are we familiar with the law and regulations which are applicable to that industry? And if we are not, do we have appropriate specialists who can help us to understand the risks and the potential misstatements which is related with that type of businesses? Related parties, we should evaluate the entity identification of accounting for and disclosure of the transactions with related parties. Now, auditors should attempt to identify all related parties during the planning of the phase of the audit. Now, what that means is we're trying to assess if there's anything close to anything which is related to related parties in the process of the planning of audit. We don't want to start the audit and later on to find out, okay, there's a related parties. Because at that point, we have to go back and change the process of the audit. That's going to take time, and that's going to make the audit more expensive. For that reason, if there's anything, we want to do it at the point of the planning. So what we need to do is make inquiries from the managers about name of the related parties, nature of the relationship, type of the transactions, and the reasons for entering into transaction with the related parties. Those are the things that we have to do again on the planning stage, planning phase of the audit. What is the source information? From where we're going to gather those information? We may check the minutes of the board of directors. We may have a conflict of interest statements from the management and others. We may have financial report information provided to the creditors, investors, and regulators. What else we can gather? Contracts and other agreements. Contracts and other agreements representing significant unusual transactions. What I want to remind you is, if you have watched the movie The Accountant, the first part, and how he did, I mean, he was technically, yes, he was doing audit. But the thing that he was chasing is, even though he didn't have enough information of the business, he didn't know enough about the business, he tried to pick up the pieces about the nature of the business during the review of the financial statements. And that's why he reviewed financial statements over 15 years. And all within those 15 years, he tried to find a pattern which are unusual. And through that unusual pattern, he started chasing, going further from but the starting point is always financial statements, and after that, going down to the single transaction. And at some point, he found these contracts and agreements, which are triggered significant unusual transactions. And that's how he found the related parties. Now, additional value of services that we might have to provide to the client. Again, audit is not the only service, so we may provide additional value-added services, but maybe tax planning. Auditor can provide tax planning, or we can do a risk assessment. But remember, if you do the risk assessment, most likely you're not going to get involved with the audit. Because if you're providing the risk assessment, then you're going to assess the risks, and then you're going to tell the client how to mitigate the risk. So basically, you want at some point you're going to review your own work. System and design and integration, that's related to the IT system design and integration. Business performance measure, benchmarking. Basically, we're doing the management assessment of the company, internal reporting, and electronic commerce. That's another type of business. Auditor provide recommendations based on the assessment of the entity business risk, and auditor who audit public companies are limited in the type of consulting services. Again, the main reason is we don't want to audit our own work. Now, documents that we're going to gather. How we're going to document the audit strategy, audit plan, prepare the audit program. And now the documents, we're going to document the overall strategy in the audit notes by identifying the nature, the timing, and the extent of the audit. So the auditor should document how the entity is managing its risk. So once we assess the risk, then we're gonna identify how the entity managing the risk and the effect of the risk and control of the planned audit procedures. So basically, is there a risk? Yes, there's a risk. Second question is the company doing anything about the risk? No, it doesn't. Then what shall we do? Well, we have to put more procedure to make sure that that risk doesn't trigger any potential misstatement of the financial statements. Or yes, company doing something about the risk. Is the company subjective? Is the company have the competence? Is the company has the procedures? Yes, it does. Then that means are those procedures followed? Then that will help us to assess that, okay, the company has internal control in place, which reduces the risk. If that reducing the risk, we're going to put less procedures, audit procedures to investigate and try to look for the error, which or potential misstatement, or which may affect the financial statements. Now, auditor eliminate now the auditor ensure that so the have address is going to help. Can you guys hear me?
Yeah. Yes, bro.
Hey, Am I losing you or everything is okay?
It's okay
got
now, Prof.
Yeah, you got disconnected earlier.
It was disconnected earlier. When
Yeah.
did I lost you? Did I lost you? Did you listen about this document and strategy?
Yes.
Okay, awesome. So I didn't lost you too much, right? Okay, let's keep going with this and let's see the documents. Now, watch this. This is kind of heavy. And business objectives and strategy. This is the example of documents, how we document the audit strategy, audit plan, and prepare the audit program. First, we're going to go with the business objectives and strategy. Now, increase market share through the sales at new international locations. That's what's happening in the company. During the current year, websites were developed for France, Italy, Ireland, and several Eastern European countries. Okay, how this gonna affect the business risk? Restrictive trade laws may affect the sales tactics. Strong consumer protection law in European countries, political instability is less developed in the less developed country, which are the Eastern European country. We're going to have the foreign currency risks once we're dealing with the multiple location in different countries. Even though most of those will be in euro, but most Eastern European countries, they're still not in euro, so that may trigger that foreign currency risk. Audit assertions. Now we're going to the audit assertions. So remember, on the audit assertions, we're going to have assertions for the transaction then events and the assertions under the financial statements or accounts and disclosures. Revenue, accuracy, reserve and returns, completeness, gain losses from the from the currency hedging. That would be violation in accuracy. Audit risk, overstated revenue may be overstated due to the pricing issues. Reserves and returns, understated due to the failure to properly track the returns in the new locations. Gain and losses. Gain and losses not properly calculated or accrued on the hedging activities. Control. Is the company doing anything on the control level? This company has installed a special group of tracking compliance to track compliance with the local and international laws. That's for the revenue. Company has placed more frequent review and returns in the new location. Company has strong control on the treasury department to the accounting and the hedging activities. How this going to affect the audit now? We're going to observe and test the group of policies and procedures to make sure that these policy and procedures which are put in place actually address the pricing issue of the overstated or understated pricing, which will be related to the accuracy of the revenue. The effect on the audit part. Then we're going to extend the audit work on the return tracking with the emphasis on the new locations. So since we know that there's a new locations, and since we know that they play some frequent review, now we're gonna have to check the frequency. But we're gonna do that through the little bit with the extended work. We'll make sure that there's no understatement or failure to properly track the returns of the new locations. We may increase the number of the hedging contract tested since they have a process in place. So we're just going to test the process. Is the process actually working in place? So that's basically idea with the audit, going through the objective and strategy, assessing the business risk, going to the assertions, which I told you are important, audit risk, internal control, effect on the audit plan. Now, the supervision of the audit, engagement partner or other supervisory member of the team, they're going to inform the engagement team members of their responsibility. They're going to direct the engagement team members to identify and communicate the audit issue and review the work of the engagement team members. That's for the partners who's going to be in charge with the audit or supervise the audit. Partner is not going to be the one who's going to go and do the counting at the year end of the inventory or the property, plant, and equipment that assures that the existence is actually those assets, either inventory, either the property, plant, and equipment, actually in place and actually exist. But they're going to send this engagement team in the place to make sure that everything is there. And if the engagement team finds some irregularities, they're going to report and communicate with the supervisors audit. Now, type of the audit tests. So what kind of audit tests we can have? We can have risk assessment procedures, test of the control, and substantive procedures. Risk assessment procedures, those will be used to obtain an understanding of the entity and the environment, including the internal control. Test of the control, those will be directed towards the evaluating the effectiveness of design and operation of the internal control. So on the first one, we obtaining understanding of the internal control. On the second one, we evaluating the effectiveness of the design and operation of that internal control, if there's internal control. And the substantive procedure will be direct material misstatement in a transaction class, account balances, and disclosure components of the financial statements. As you can see, the substantive procedures are more, how can I say, more rich and directly to the point related to the level of assertions. Because here talking about the transactions, we're talking about the accounting balances, and we're talking about the disclosures. How are we going to test the control? By making the inquiry, making observation, making inspection, doing rep-performance, or we can do just simply walk through. What is the inquiry? Inquiry is the appropriate, we're going to require some information from the appropriate management supervisors or staff personnel. Observation, we're going to specifically observe the application of the specific control. Inspection will be that we're going to inspect the documents, reports, and electronic files if there are any. Rep-performance, that will be the application of the control by the auditor, and walkthrough will involve tracing the transaction from the original to all the way to the inclusion of financial statements. So walkthrough, that's a term in the audit, means to trace something from the what will be from the phone call which somebody made, so that create this, let's say, sales order, from the sales order all the way to the financial reports, which is included into the revenue and the income statement, on the income statement. Now we can have, this could be combination of the audit procedures, including inquiry, observation, and inspection. We're going to ask for the inquiry, we're going to observe, and we're going to inspect. How are we going to examine the internal control and test the control? Let's say the internal control. We're going to create a separation of duty between the shipping function and the other entity or billing functions. How are we going to test it? We're going to observe and evaluate whether the shipping personnel have access to the other entry or billing activities. Let's say the next one. Internal control is to credit department personnel initial sales order indicating credit approval. Now we're going to inspect a sample of the sales order for presence of the initials of the credit department personnel. If we cannot find on the sales order initials of the credit department personnel, that means that internal control doesn't work. What that means? That means that anything related to this part of the nature of the company, that means all the reporting, we have to put more audit procedures to make sure that there's no material misstatement in the financial statements. The next one is the billing department personnel account. Personnel accounts for the numerical sequence of the sales invoices. So what we're going to do, we're going to inquire from the billing department personnel about missing sales invoice numbers. Tell me from invoice 1 to 1000, how many are missing? We have exactly 1000 invoices. If we have exactly 1000 invoices, there's nothing missing. That means internal control works. And the next one is the agree sales invoices to shipping document and customer order for the product types, price, and quantity. Then we recompute the information on the sample of the sales invoice. So we're going to get the sales invoice. We're going to go with the product type, price, and quantity. We're going to recompute all the items on the invoices to see if actually it matches. That's for the test of the control. The last one was the substantive procedures. On the substantive procedures, we can attest the details and we can have analytical procedures. The test of the details, we're gonna test for errors or fraud on the single transaction or in account balances or in disclosures. On the analytical procedure, we're going to evaluate the financial information through the analysis of plausible relationships among the financial and non-financial data. So basically, through the financial and non-financial data, if we see some irregularities, that's how we're going to trigger some audit procedures in order to see those will be called analytical procedures. With the test, we're chasing this dual purpose, test of the control and the substantive test of transactions. That's how we're achieving this dual purpose test. This is often makes sense to design audit procedures to conduct both test of control and substantive test of transactions. And that will be on the same document. Materiality. Now, careful with the materiality because materiality, once we assess the audit, once we establish the audit strategy, audit plan, or procedures, then we go to materiality. Unaccepted interpretation of materiality is that a fact is material if there's a substantial likelihood that the fact would have been viewed by the reasonable investor as having significant altered the total mix of information made available. So that's a very heavy description. Again, if you want to read it a few times and see if that still makes sense. But in reality, materiality is that, is there anything in the financial statements that if the decision maker knows about it, that's going to change his decision. Materiality is not absolute, and it's not black and white issue. Now, it requires professional judgment. Who's going to be professional? Who's going to have to exercise his professional judgment? That will be the professional, which most likely will be you. So you'll be the one who have to determine the materiality by expressing your professional judgment. Steps. First, we're going to determine the overall materiality. Then we're going to determine the tolerable misstatement. And the last one, we're going to evaluate the auditing findings. Let's start with step 1. Determine the overall materiality. Now, there are 2 types of materialities in the materiality. Now, here it says determine the overall materiality. Then we determine the tolerable misstatements. Tolerable, one is called overall materiality, the other one is the performance materiality. That's how usually it's called in the practice. Simply way to put it is, you should think of this way. Overall materiality is for the users of the financial statements. Performance materiality, in this case, determine the tolerable misstatement, is the materiality for the auditor. Our first one is the overall materiality is what's the amount of the mistake, or what's the size of the mistakes that will not affect the decision maker decision by knowing that there's a mistake inside. That's the first. Second one is the performance materiality, or tolerable misstatement in this case, will be what's the mistake on the financial statements or in the transactions that not going to change the auditor's opinion about the financial reports. So as you can see, one is related to the on-site users, and the second one is what is the mistake that the auditor is comfortable of signing the audit report, unqualified audit report, knowing that there might be misstatements in the audit. So the common quantitative benchmark is used for establishing the overall materiality. Now, if you take a once you take a look at the audit standards, the audit standards actually guide you which comes first, which ones comes second, on determining the overall materiality. And on the audit standards, they even give you the percentage. So the common quantitative benchmarks which are used to establish the overall materiality is the first, income before income tax. Now, what if the company is having a loss? What are we going to do in that case? And obviously on the loss, you cannot go with to use it to establish the overall materiality. So what you have to do is you have to go to the next one. First one will be income before income taxes. Second one will be total assets. If the total assets is not appropriate for some reason, then you're going to move to the total revenue. Imagine you're dealing with an IT company that the main asset is the humans. The humans are the main asset in the IT company. which providing ERP software. There's no assets. Because probably all the computers are rentals, or they're using some basic computers which are not expensive, and everything is remotely done. The total revenue, if the total assets is not appropriate, then we move to the total revenue. Now, in case we have a loss, right? We have a loss. The total assets are not appropriate, then we're going to go to the revenue. The chances the revenue to be negative is 50%. Actually, there is not going to be business if the total revenue is negative or zero. Then we can go with the net assets, or then we can go with the net total equity. And that is only and only in case if the net income is not before income taxes. Now, the quantitative amount, once we establish the quantitative benchmark, then we have to come up with the amount. Quantitative amount may be adjusted, lower of qualitative factors such as material misstatement of the prior year, so again, we may increase or decrease the quantitative amount which we're going to use. So first one, which are the events that are going to trigger this? First, material misstatement on the prior year. In the previous year, we found that there's not material misstatements. High risk of fraud. If the risk of fraud is very low, then that's going to affect on the quantitative amount. Potential loan covenants violation. If we sense that the potential law probability of the violation of the loan covenants, where we have to adjust the amount that we're going to use, the materiality. Small amounts may cause the entity to miss forecasted revenue or earnings, or effect on the trend of earnings. Or the entity operates in the volatile business environment, which has complex operations and operates in the highly regulated industry. All those circumstances may affect the amount that may be used for the materiality to be adjusted. That's on step one. Let's see now the step two. What's going to happen with step two? Step two, we're going to determine the tolerable misstatement. Tolerable misstatement is the amount of planning materiality allocated to the accounts or class of the transactions. Combined tolerable misstatement is generally greater than the planning materiality because not all accounts will be misstated by their full tolerable misstatement allocation. Audits of the individual accounts are conducted simultaneously. Materiality is often a small fraction of the accounts being audited. When the error is identified, additional testing is typically performed, and overall materiality serves as a safety net. So we have our safety net, and then we're going to the tolerable misstatement. The third one is to evaluate the audit findings. When the audit evidence are gathered, we're going to see that do we have aggregates misstatement from each account or class of transactions. We're going to consider the effect of the misstatement not adjusted in the prior period, if there's any. We're going to compare the aggregate misstatement to the overall materiality. And if the aggregate misstatement is less than the overall materiality, then we can conclude that the financial statements are fairly presented. So those are how we're going to evaluate the audit findings. So again, the three steps for the materiality is determine the overall materiality, moving to the tolerable misstatement, and evaluating what we found during the audit. those can affect our materiality. Now, which one of the following would be auditors most likely used to determine the overall materiality when planning the audit? Take a look at this and tell me what you think. This one is very straightforward. There's nothing scary here. What do you think the right one will be here?
As you have mentioned, Prof, there are level to assess. So one is the entity's income before taxes.
So which one are we going to choose for the for our overall materiality when we're planning the audit? Obviously, we're not going to use the results of the test control. We're not going to use the content of the engagement letter or anticipated size samples. We're going to stay with the entity income before taxes for the period to date, right? And that's we're going to use. That's what will be most likely to be used in determining the overall materiality when we're planning the audit. So in this chapter, there's a lot of things. Again, everything is related to the accepting the client, understanding the client business, deciding shall we accept the client or not. If we accept the client, then we're going further and start performing assessing the business risk, materiality. And now we're going to keep going with the next one. We're not going to stop here, even though this is the end of the chapter. I'm going to give you a short break, and then we can. So now we're going to start assessing the risks. In order to understand the audit risk, so we have to see what our audit risk is. The risk that the auditor expresses. Auditor express inappropriate audit opinion when the financial statement are materially misstated. This is the audit risk. Is the risk that the auditor expresses inappropriate audit opinion when the materials for financial statement are materially misstated. So we're saying one thing, but in reality is something else. Now the assertion level is on the assertion level, we're gonna have a financial statements level, and we're going to have a individual account balances and disclosure level. Now, the audit risk model is combination of three risks. First one is called inherent risk. Second one is the control risk. And the last one is the detection risk. The formula for the audit risk is simply audit risk is equal to inherent risk time control risk time detection risk. Now, having in mind that the audit risk, we want to lower that risk, right? The risk that we can express something else if it's something else happening, we want to reduce that risk to very minimum. We actually want to say whatever exactly is. But having that in mind, the formula, we're going to see that we have to do with the three risks, and within all those three risks, we have a computation. So in order all the risks to be low, all those numbers have to be low. If one of those numbers is high, then the audit risk is going to be high. But what we can do is the only risk that we have in here in our game that we can play with is the detection risk. So let's see the nature of the risk. Inherent risk is a susceptibility of an assertion in the account and disclosure to a misstatement due to error info that could be material, but would be material before consideration of any relevant control. So this one is kind of heavy. Now, inherent risk, you can simply say that inherent risk is related to the nature of the business and the environment that the company working is currently in. And that will be, again, assertions. We're talking about assertions on the account or disclosure. It's not the transaction and events, and then the account disclosure. A misstatement due to the error or fraud that could be material before consideration of any related controls. Before we even go to the control level, this is the anything that may happen, which is related again to the business. Second one is the control risk. Control risk is the risk that a misstatement that could happen in the assertion about the accounting disclosure. So now we're talking about the second assertion, again, accounting disclosure. And that could be material, will not be prevented or detected or corrected on a timely basis by the entity internal control. So we have to have that in mind, that in the control risk happen on the level of the company and the level that the company had put some control procedures in place. So this is the risk that can happen if those control procedures do not work appropriately. And detection risk is the risk that the procedures performed by the auditor to reduce the audit risk to the acceptable level acceptable low level will not detect misstatement that exists and could be material, inappropriate, basically inappropriate audit procedure, misinterpreting the audit evidence, or failure to recognize a misstatement or deviation. So simply said is inherent risk is risk related to the business and the nature of the business. Control risk is the risk related to the internal control procedures in place. Detection risk is the risk that auditor skipped the procedures, spent less time, and did not detect the misstatements on the financial statements. So now, having those in mind, and knowing that inherent risk and control risk is equal to the risk of material misstatement, detection risk is non-sampling risk is sampling risk. So if we have non-sampling, obviously the risk will be high. If we have a lot of samples, then that risk will be low. Non-sampling risk will be if we don't have a samples, what will be the risk of not having sample risk is if we have a samples, what will be the risk about that? So simply said, the audit risk is again computation between the inherent risk, control risk, detection risk. Inherent risk and control risk, there's not much we can do. This is more like a auditor don't have too much power to change those risks. We can identify it, we can assess it, we can test them, and we can confirm them. But there's not much we can do about it. On the detection risk, that's where the auditor comes. So if the inherent risk is low, control risk is low, then the detection risk can be high. If we want to keep the audit risk, let's say we want to keep the audit risk, let's say at some level, let's say 10. 10 is a random number, just a sample. If the inherent risk is 1, credit control risk is, let's say 2, then the detection risk can go up. That means there's not much risk in the company and the business. We know very well the business. There's not much right now in the industry, no risk at all. Control risk, there's a control risk in place. Everything is followed, the procedures is followed, we test it, it's okay. So now on the detection risk, we can be a little bit less focused. And we can still get the audit risk on the level that we want to be. Now, if the opposite happens, then we have to lower the detection risk. What that means is, if the inherent risk is high, let's say inherent risk is 2, credit risk is 5. Now we're already on 10. The only way to keep the audit risk at 10 is we to lower the detection risk. How can I lower the detection risk? By putting more procedures in place, making the audit very heavy, extending the amount of the time, though, extending the all the accounts and the transactions and the balances that I'm going to test. That way, I'm going to reduce the detection risk to level 1. And then I'm going to have 2 times 5 times 1. I'm going to be on level 10, which I want to be the audit risk. Make sense? So that's the only game that we have with the audit risk. How can we keep the audit risk low or lower the risk by increasing or lowering the detection risk? And the only way to lower the detection risk is to put more audit procedures, increase the time of the audit, putting more people into the audit, be more detailed in the audit. And that's going to lower the audit risk. Now, let's go with the simply, again, explanation of the engagement. And now we have engagement risk. Engagement risk in the time when we sign the engagement. Now, everything is risky. There are risks everywhere. Now, the question is, can we see the risk? Can we assess the risk? Can we do something about the risk? First one is the engagement risk. Engagement risk, we're going to have limitations. We're going to have the adverse publicity, and we're going to have other events arising in connection with the audited transaction, but the auditor's exposure to financial loss and damage to the professional reputation. That's the engagement risk. If we get into the audit with the company, what are the risks for us? Well, if the client have difficulties and there's a lot of misstatements on financial statements, the client asks us to sign the unqualified report when in fact there's a lot of irregularities. How this going to affect us? Well, that can expose us to some financial losses. We may lose the money because of the penalties and anything that we may suffer because of the engaging with the client, which doing something inappropriate. Second, we may lose our reputation. Means that obviously later on we're going to lose clients. So, but those are the risks only for the getting the new client. How we're going to use the audit risk model again. We're going to set the planet level of audit risk. We're setting up the audit risk, which is the final result. We're going to assess the risk of material misstatement, which is the inherent risk and the credit risk. And then we're going to work out to find out where our detection risk should be. So basically, auditor using the level of the detection risk to design the audit procedures, which will reduce the audit risk to the acceptable level. Again, if the material misstatement, risk of the material misstatement is high, the only way we have is to keep the detection risk low. How can we keep it low? By adjusting the audit procedures during the audit. Audit more procedures. Audit more testing. Audit more people into the audit. Increasing the time of the audit. Well, that will be more expensive to the client, but that's how we keep the audit risk low. Simple example will be auditor assess each component of the audit risk model using the either quantitative or qualitative terms, either numbers, either to high and low. First example is we want to keep the audit risk very low, but risk of material misstatement is high. That means inherent risk and control risk are high. The only way we to keep it low is we to lower the detection risk. Now, if you want to have the audit risk low, but risk of material misstatement is also already moderate, the only way to keep it low is we to detection risk to be on the moderate level. And that's how we're going to keep it low. Not very low, but it's going to be low. Third option is if we want the audit risk to be low and the risk of material misstatement is already low, now detection risk, we can go easy and we can have a higher risk here. That means less procedures, less people, less time. And that's how we're going to keep this audit risk on the low level. So in this case, for example, 3 on the table above, why is the auditor setting the detection risk high? What does the high assessment of detection risk mean in terms of the level of audit testing? Well, in this case, what it means is that the detection risk is set high because of the risk of material misstatement is low. What that means to us in terms of the detection risk means that in this case, we have to do less testing. Less people are going to be involved in the audit, less time we're going to spend on the audit. We can afford to have the detection risk on time. Now, which are the limitations of this as audit risk model? Everything, I mean, the theory looks okay, but which are the limitations? Again, it's a planning tool. However, it has a limitation, which has to be considered when the model is used. Model is only as good as the judgment and assessment used as inputs. So basically, if we're using the wrong judgment and if we're doing the wrong assessment, then we're going to have a problem. And the desired level of audit risk may not actually be achieved. That's another thing. That's another limitation of this model. So auditors, how the auditor is going to assess the risk? There's the procedures. First, we're going to perform risk assessment to obtain an understanding of the entity and the entity environment. Now, I know, if you remember, before we engage the client, we already assessed the client. We already assessed the business. But we didn't check for the risks. Now we're doing the different assessment. We're doing assessment on the risks by getting more understanding of the entity and see which are the risks. Again, risk that we're chasing is the risk of material misstatement. Means that if once we already said the materiality, we're gonna take a look is there anything that maybe any events and anything that happened in the business that might tempt the managers of the company to violate the materiality or do some activity which may affect the users of the financial statements. Second thing is, once you obtain the understanding of the risk assessment, once we get the understanding of the entity and the entity environment, that's going to help us to identify the business risk. And then we can understand the potential misstatements that can cause. So, for example, imagine this. The company just changed their CFO or the controller of the company. I mean, let's say this is a repetitive client, which we audited for last couple of years, but last year the controller retired, and they hired new controller, which doesn't have a CPA yet, but he's just enrolled in the PEP program in CPA, and he's changing his profession. His previous profession was what will be his first profession? He was ballet dancer. Let's make it more dramatic. Now the question is that going to affect the risk? The business risk and the potential of the misstatement of the financial statements? Obviously, yes. Why? Because even now he's not a CPA. He's in the start of the PEP program, that means he's not having the experience. If he's a ballet dancer and he's changing his profession, most likely he doesn't have accounting experience. So now we have a potential of high business risk. Where is that going to hit us? Now we have to increase the detection risk. Means we have to put more procedures in place, more audit. We have to do more audit planning. We have to do more testing in order to test and see is there actually any misstatements from the fact that the person who's who is in the head of the accounting doesn't have accounting experience. Now, again, this is the last thing. Once we perform the risk assessment to obtain the understanding of the entity environment, this will help us understand how to identify the business risk and understand the potential misstatement. And because once we get the responses of the entity to the business risk related to the auditor who says the risk of the material misstatement, once we get those responses, we're gonna assess the risk of material misstatement. Is it high? Is it low? So, for example, the fact that the company changed the controller, or the previous controller retired, they hired new control, we have no accounting experience. What is the risk of material misstatement? High or low? Obviously, it's going to be high. If that's high, that means we have to lower the detection risk. So let's see overview of the auditor's risk assessment process. First, we're going to perform assessment procedures. We're going to inquire from the managers about the business entity, about the business environment, about the nature of the business, anything. We're going to do some analytical procedures, including the audit data analytics. And we're going to do some observation or inspection. We're not on the testing here. We're just observing. To get some understanding about the entity as a business and the environment that the entity works. That will involve what we're chasing here. Nature of the entity. By doing this, we're chasing from nature of the entity, industry, regulatory, external factors, objectives, strategies, business risk, objectives, company objectives, strategy. What's their strategy? What's their ambition? What's their vision? What's the business risk? Then we're going to check the company performance measures. We're going to check the simple, we're going to just do the simple financial statement analysis. We're not going to do it. We're going to plug all this information into the computer, and we're going to ask some artificial intelligence to analyze the information and give us the final result. And then we're going to assess the internal control. Once we identify the business risk, again, we're doing observation of the internal control. Is the internal control in place? Is that exist? We're not testing it yet. We're going to test it later in the lecture. Now we're going to identify the business risk that may result in material misstatement. Once we do that, then we're going to evaluate the entity risk assessment process. How the management respond to those business risks and obtain evidence of the implementation if the manager identified that there is a risk and if they put some process in place to reduce the risk. That's why, as you know, at Center School of Management, they have a risk assessment. A risk assessment director risk assessment. Once we assess the risk of the material misstatement, of the financial statement, and the session level, and that's where, let me see, with assessment, and that's where the assessment is. The last one is we're going to assess the risk of material misstatement at the financial statement and the session level. And we're done with this. This is the whole process. So as you can see, we're not just doing, how can I say? We're not just simply doing audit. We're going deep and we try to find everything about the company. Now, is it done by, this is by the books. Is this done in the reality? It should be done by in the reality. Sometimes the company that are doing the audit, due to the pressure, due to a lot of other things, they might not go directly to the way we're explaining audit process and audit procedures here, but they should. Once we assess the risk, and so what will be the procedures that we're going to put in place to gather the evidence? Again, we can inquire some, we can make some inquiry to the management or to the outside entity in order we to understand. Again, remember the objective here is we to get understanding about the business. We to get the understanding about, is there any risks? Then we're going to use some analytical procedures. Analytical procedures, we're going to analyze the data from the financial statements. That's why I'm going to ask for more than 3 or 10 years financial statements. More information you have, more procedures you can run, and more data you can collect. And then we're going to do this simple observation and inspection. Again, we are not on the testing yet. How are we going to understand the entity and the environment? We see the nature of the entity. We're going to get information about the industry, regulators, external factors. Then we're going to chase the company objectives, strategies. Do they have a risk department? Are they assessing the risks? Then we're going to check, is the company has internal control? At this level, we just observe it. And we can do some performance measures of that. Check the financial statement from the previous years, run some reports and test financial ratio analysis, compare those ratios and see what's the trend in the company. This is how we're going to get understanding. Now, the nature understanding, to understand the nature of the entity, the auditor should obtain information about business operations, revenue, from where the revenue comes, what are the sources, what products they're selling, what services they're providing, how is the market, the conduct of the operation, alliances, joint ventures, outsourcing activities, locations, warehouses, offices, key customers, important suppliers. If we're in the business of, if we're in the merchandising business, basically buying and selling, which are the key suppliers for the goods and the services. We're going to observe the ownership and the governance structure of the organization. centralized, decentralized. Who is responsible for what? Is there any formal procedures in the company? And I think that's where I'm gonna stop, because I want we to make a next time we to start with again with the whole picture of the business of the audit, sorry. Then we're going through the different stages of planning of the audit. Again, we are level the planning of the audit. At this level, when we're assessing the risk, we're still at the planning stage. Once we get the understanding, when we set us risks, see all the risks, then we're gonna set up the audit risk or detection risk. And once we do the detection risk, we're gonna start doing the audit procedures. We're not even close to the audit procedures yet, but we're getting there. Okay, that will be all for me for today. As you can see, the things are getting interesting.